Okay, so I hope you can see my screen. Right, so for today, we will be covering on RSI divergence trading strategies, right? I bet this should be RSI. Right, so just a quick introduction of myself. I'm Lee Sing. I provide FX advisory to institutional clients. You can also find me on LinkedIn. So if you have any questions with regards to the analysis of materials, right, done on Wednesdays, Thursdays, and Fridays, right, please feel free to reach out to me on LinkedIn. Just a quick disclaimer, the information presented here, it's not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today, right? So first we will take a look at bullish divergence as well as bearish divergence, right? And also how we can combine these setups with market structures. So essentially to form our analysis. And then following which we will also take a look at how we can manage risk in terms of trading divergence, right? And then finally, right, the divergence on the technical indicators. So let's take a look at RSI, right? So in general, before we start the session, right, let's just take a look at what RSI is, right? So this is actually a quick recap of our previous session. You can see that on RSI, right? So essentially, this is basically RSI itself. It's a technical indicator. And what it does is that it measures strength and momentum in prices. Right? So how this is being done, it's that it compares the average gain, right, over the average loss of this price, right? So we've covered in very deep details as to what RSI is and how we can use them, right? So the general use of RSI in trading in our previous session. So if you guys have any questions on that, right, do take a look at the recording. Okay, so this is on RSI, right? So you can see that on average, right, the default period used on RSI, it's 14. It can be plotted on a scale of 0 to 100. Okay, so in general, right, the default setting for RSI, it's just 70 and 30, right? So you can see 70 and 30 respectively. And if you want to make the band narrower, right? So how RSI works is that there is this band, right, that you can identify. And essentially, if price enters into the oversold region, so this is the overbought region, and this is the oversold region. Okay, so let's say price enters into an overbought region and it exits the region, right? So this sign itself, right, on the exit of a RSI, especially if accompanied with divergence, right? You can see that in this example, probably not, but we will cover in further details, right? But the idea is that if there is a divergence, then what this does is that this is a sign that the upward momentum might be losing, right? Essentially, you can interpret it as a lack of buyers to push price higher. Hence, we could be seeing a potential reversal. Right. And then if price enters into the oversold region, right, then the inverse is true, right? So this is just from a theory perspective. So if price comes into oversold region and exits the region, right, then we could see that reversal in price. Of course, we want to combine this with market structure. So ideally, in this kind of scenario where we're expecting a reversal here, you want to ensure that on the higher time frame, right, this exit of the region, on the higher time frame, you're actually in a bearish market structure. Then that will make sense, right? Because if price pulls back, then you can see that within this pullback leg itself, right, actually starts forming your lower time frame bullish structure. And once there is that exit, right, then this would correspond with the higher time frames bearish order flow. So it's the same thing here, right? So if price exit the oversold region, then what we have is that when we have a bullish market structure, right, price enters into this zone. You can see that when price exit the oversold region, right, essentially we're looking at this downtrend on the lower time frame and that change in structure, and that would then be aligned with the higher time frames demand area before continuing on the upside. Okay, so in general, RSI itself is a leading indicator, right? It's not like moving average. So this measures momentum and price, right? Rate of change of price. And when RSI enters overbought and oversold region, right, of course, we don't want to trade it in isolation. We want to ensure that this is also in line with market structure. Okay. So I hope that this is clear, right, in terms of how we can use RSI. So let's take a look at the next slide. So for the next slide, right, essentially we will be covering on bullish and bearish divergence. right? So for bullish, bearish divergence, let me just remove this, right? So in general, what it's a bullish divergence, right? Bullish divergence just means that you have a potential momentum shift, right? So the idea is that price continues to form lower lows. Oops. Let me just go back. Right, so for bullish divergence, the idea is that price continues to form lower lows. You can see here. Okay, so price continues to form lower lows and lower highs, right? So this is in price and it's a bullish move. Whereas for RSI, right, essentially it starts forming higher lows. So the best case scenario for this is that there is an exit of the oversold region, and then accompanied with that, there is also a bullish divergence. Right? So then this gives more confirmation that we could indeed see a reversal in price, or at least a pullback within this leg. But do be aware that if you're in a bearish structure, right, trying to play this small term bounce up, right, it's just a pullback leg before it continues to the downside. So in such scenario, right, the best scenario is to, in such scenario, the best case is just to wait for an exit of the region on RSI. And another thing is to wait for a change in structure on your lower time frame. So that would then suggest that it is indeed, there is indeed a change in structure, right? And that change would reflect on the higher time frame, especially if on your higher time frame is currently sitting on, let's say, a support area. So RSI itself is also useful, right, for short-term changes in the market, right, as compared to trend following indicators, again, right, for short-term reversal. So again, we want to incorporate market structure in this, which we will take a look at it, right, in uh, deeper details. Right, so we need to take into account market structure, supply demand areas, as well as the overall direction of the trend. Right, so as mentioned, if you're in the downtrend, then any pullback itself into this leg, right, it's best to wait for an RSI exit of the overbought region before playing the move to the downside, and this would then be in continuation with the higher time frame structure. So for example, right, in this other example, there is this case where you have prices on the higher time frame forming bullish market structure, higher lows, higher highs, coming into a demand area here, for example, right? This demand area can be determined based on a few criteria, right? So one, it's of course based on just looking at candles, right? Reaction with each candle. So trying to find smaller time frame consolidation areas, right? Before price breaks out of that zone. Or looking at areas where price interacted with multiple times, right? There's a lot of reaction of these zones, right? So those are areas that you want to consider as well. Okay, so these are the areas that we want to take a look at. So coming into this zone, you see that when there is a bullish divergence here, and price comes into this zone, right? When there is a bullish divergence, it shows that there is usually an exit of the oversold region. So we need to ask ourselves, right, when is the best time that this exit or this signal itself would be, or would give us a higher probability? It's when price, it's in a bullish order flow, right, or bullish market structure on your higher time frame, and on your lower time frame, right, this exit basically reflects the lower time frame's bearish structure, and that exit would be best, right, if it corresponds to a change in structure on your lower time frame. Okay, so I hope that this is clear, right? Let's take a look at a few examples of that. So this is on bullish divergence, right? If you're on bearish divergence. Okay, so let's take a look at an example on bullish divergence, right? So the first thing we want to keep a lookout for when we are looking at divergence, right? It's again market structure. So if market structure starts forming higher lows and higher highs, right, then we know that we want to focus more on the overbought region, oversold region, right? So if prices are forming higher lows and higher highs here, let's just draw this. Okay, so if prices start forming higher lows and higher highs, then we know that any pullback, right? So if it's forming something like that, any pullback itself, this leg on the lower time frame is actually bearish market structure. And if this is bearish market structure, right, it should correspond to RSI and exit of the oversold region, right? Which shows that there is a potential reversal and it will be in line with the higher time frame. So when we're looking at structures or examples like this, the first thing we want to look at is, of course, we want to look at the highs, right? We want to ensure that if it's a bullish market structure, the highs are continuously violated, whereas the lows themselves should hold. So this is the first sign, right? Looking for that break in structure, and this comes in here. So you can see that with the most recent move, right? If I were to trace out the movement in price, you can see the price starts forming higher lows, higher highs over here. You can see this area, right? So price came in here, this high, broke below the structure. So which means that if this area is not to it's to hold, right, price should be breaking past this high. That's the first one. So you can see the price broke above this high, right? So in this case, when price broke above this high, it pulled back, and we see this strong support level being formed, and this support level is validated with that break in structure, right? So if I were to just move back maybe 3 steps back, you can see that price came in, it swept the low. You have equal lows that are being formed over here. What this suggests with the equal lows is that there's a lot of liquidity lying below, right? So what I mean this is that you can see the support level. So naturally coming into the support levels, right, traders would, number one, either enter a long position or accumulate buy positions at this area, the support level, just basing it off support level. Or if they're trying to play breakout trades, right, they will include sell stops here. So when price breaks below, right, you can see that there is a lot of sell stops that are being triggered. But what this also shows is that you can see there's a lot of sell side liquidity here. It can be in terms of stop losses for the buy orders, right? So if you're placing buy orders here, the stop loss would just be slightly below. That's one, right? And the other thing is that if price comes and breaks below the structure, right, sell stops will be here. So you can see that these are all sell side liquidity. So when that happens, right, market came into this zone, tapped into this area, you can see that sweep below, and then it broke structure. It broke above the high. So this is the first sign of a change in bullish or a change in market structure, right? When price swept below the low over here, and this sweep, right, it's also caused by a break in structure. And you can see that pullback forming this low, right? So we might not have caught this low, right? Because if you take a look at it, right, either looking at support resistance areas, right, you can see you extend across, this might be a potential support. Right? Of course, this is on hindsight, so we might not have caught this one, but you can see the second structure or second break in structure is very clear here, right? So price came in and formed a new high, pulled back. So we know that following this, right, the first confirmation comes in here. The second confirmation comes in when price breaks above structure. Again, right, in a bullish structure, we're expecting the lows to hold, right? So recall earlier this that we drew. So we're expecting this lows to hold, whereas the highs are violated. So in this example, you can see that this lows held, whereas the highs are being violated, right? So when price broke above and pulled back, you can see that this was the support level. And then following that, price came back into this area here. Okay, so when price came into this zone, right, the idea is that this is the low that we have here. So we're not expecting this low to be violated, right? Idea is to put the stop losses, right, slightly below this zone. But what's also interesting is that apart from just looking at structure, right, you have this over here. So when price comes into a support area or demand area, right, you can see that if this is accompanied with a bullish divergence, and more importantly, in an uptrend, right, we want to focus on oversold region. So we're looking at an exit of the oversold region, right, which it's basically this area here. You can see that these are the bands, right? So this is the 70 level and this is the 30 level. The idea is that this 30 and 70 bands, right, represent the overbought and oversold region respectively. Comes into this zone and it exits this region, right? That's the first sign that we're seeing a bullish structure, and it's in line because it's in line with the order flow, right? It's in line with market structure on your time frame, right? Based on what we have seen earlier. If this bullish move is to continue, right? Or if this bearish trend downwards here is to end, we can see that change in structure, which first happens here. You might not want to take the first confirmation, right? And you can see following that this was being formed as well. So when there is this bullish divergence, then this would be aligned, right, with the higher time frames of the flow. That's one. And the second thing is that you can see the exit of the region, right? So when price exited the region on the oversold, notice where we are here. When price exited this region, right, you can see that it's basically in the downtrend, right? And the first exit comes in over here. You can see the first exit comes in here. And this corresponds to that pullback in price, right? So the exit comes in somewhere here. You can see price pulled back slightly, right? And it came lower, which forms your divergence. And the second exit comes in here. So this exit itself, right, corresponds to this move. And then you can see following which, right, when price forms a new low and there is this bullish divergence with a break, right, the structure or confirmation on the low time frame might come in here. But you want price, right? So you can see if I to zoom into the lower time frame, right? Because this is a static image, so I cannot do that. But if you take a look at where we are, like in terms of price, you can see that the lower lows and lower highs over here, right? So price came in, you can see subsequent lower lows and lower highs, and then following that a break. So if you want to wait for more confirmation instead of just trading based on divergence, right? You can see that this is the last high that we have. So once price breaks of this area would then be the support region. Okay, so I've also covered on supply and demand areas or support resistance areas. You can see that this area itself, right, this is a new low, price broke above it, came in, swept this region, right? So when this happens, you can see that this candle itself can actually serve as a demand zone. Okay, so this is one, right? And then along the way up, you can see support turn resistance areas turn support, right? The rejection, price broke above it, strong bullish move up, and then if you were to extend this slightly, you can see that price came into this zone again. Okay, so this is on bullish divergence. Right, let's take a look at another example. So right now we are also covering on bearish divergence. Right, let me just clear this. Right, so for bearish divergence, it's slightly different. So when we talk about bullish divergence, we talk about price forming higher lower lows, right? So price form lower lows, ideally in the bearish market structure, whereas for RSI itself, right, it forms a higher low, so something like that. And this is the best case scenario, right? And for bullish divergence, if you're bearish, right, that is the other way around, right? So bearish divergence is formed when price starts forming a higher high. You can see subsequent higher highs being formed, and stochastics itself forms a lower high. Okay. So this is an example, right? So this is an example of highlighted. You can see it. This is a bullish structure. Price again broke above structure here, broke above the last high, pulled back into a support area, and you can see consistent higher lows and higher highs being formed. If I were to ignore structure, right? So just take it solely based on RSI, you can see this example, right? So price starts forming higher lows. Higher highs, sorry, right? So you can see subsequent higher highs being formed, whereas for RSI, right, number one, it exited the region, exited this overbought region. So this is the first sign of a bearish signal, right? Ignoring market structure. So if you want to trade it just based on RSI, right, then exit of the overbought region is one signal, and you can see bearish divergence, right, which shows that there's a lack of buying momentum. So in this case, you can see that price forms a higher high, but on your stochastics, right, it actually forms a lower high. So in such scenario, right, if we're to just ignore market structure, you can see that price came in, right, it did a pullback, slight pullback, back into the support area here, right? So notice this. This bearish divergence that we're seeing, right, just corresponds to a slight pullback in price following that, coming back into a support level. It was a previous resistance turn support level, right? We saw that rejection twice and then a break above structure. So based on support resistance series, you can see that this is the support level, right? Price came in, tapped into the zone. So what I'm trying to bring across here is that even though, right, divergence itself, right, can be confirmation signals, again, we cannot ignore market structure. Right, so if you take a look at this example, right, as compared to the bullish divergence example, right, in this example, bullish divergence takes into account the market structure, but when you look at bearish divergence, it doesn't take into account market structure, right? We're in a bullish market structure, right, which also means that highs themselves are easily violated, right, whereas lows themselves will hold. So when you're trying to play a reversal on the bearish divergence, right, just solely based on divergence, you can see that this divergence themselves, right, they might have generated accurate signals, but the signals, right, just cause slight pullbacks before it continues in the direction of the trend. That's one, right? And the other thing with this analysis is that you can see that this analysis, right, is solely based on one time frame. Right? So there isn't a higher time frame, there is no direction. For all we know, that price might be sitting on a support area, a key support area, which caused this whole move up. And this higher lows and higher highs that we're seeing on the lower time frame itself, right? This actually corresponds to a huge pullback here, right? A huge pullback, which is this leg of the entire trend. Okay, so this might be a higher time frame structure that you're looking at, right? And then this whole leg, this whole upside that we're seeing over here just corresponds to this move up here. Okay, so we wouldn't know, right, if we do not analyze the bigger time frame. Okay, so the main contrast between trying to show these two examples is that number one, right, we need to ensure that we are looking at structures, right, market structures in order to determine the general direction. And the second thing is that, right, depending on market structure, we would then want to tailor our focus according to it. Either we want to focus on the overbought or oversold region. If it's in a bullish structure, right, it makes more sense if you are doing trend following strategies, right, buying into support areas, then you want to focus on price exiting the oversold region on the lower time frame, because any pullback into the support area itself, right, this is actually represented by a bearish move on the lower time frame, right? So if price exits the oversold, it just shows that there's potential for a reversal on the lower time frame structure, and that would be in line with a higher time frame bullish order flow. Okay, so if prices are in a bearish structure, then the converse is true. So if it's in a bearish structure, lower lows and lower highs, then you want to focus on the downside, which is this area, right, the overbought region, because any pullback into this zone, right, you can see this pullback itself, price comes into a resistance area, right, and it's probably going to continue lower. Okay, so we need to ensure that we tie in with the higher time frames direction. Right, so let's take a look at an example, right? Let's see on Aussie dollar. So I'll just bring up the chart in a moment. Okay, so let's see this. So in this example, right, on Aussie dollar, okay, so let's apply the same RSI technique that we have, right? So this is Aussie dollar on the weekly time frame, right? So let me just load the RSI first so that we have an idea of how we can combine the analysis across the different time frames, right? So in this example, you can see on RSI, right, we have the weekly. So on the weekly time frame, right, it's this zone here. So you can see that on the weekly picture, right, for Aussie dollar, it's currently sitting on this area, right? You have the most subsequent moves here, lower lows and lower highs. That's one, right? So bearish structure. You see price coming into a resistance area here. Right? That's another one. Right. And then what we have following this, we move on to the daily time frame. You can see on the daily time frame, right now prices are pushing back into the zone on the daily, right? So we're seeing some kind of pullback over here. But on the higher time frame, still sitting on the daily zone. Right? If you're on the 4 hours time frame, prices are pulling back, right, into this area over here, right? And for RSI, right, so if you look at the 4 hours, it's actually still bullish, right? If you take a look at the most recent structure here, look at the highs and look at the lows. So price came in, right? There's this change in structure from this move, and then subsequently prices are just forming higher lows, higher highs, and more importantly, on your RSI, you can see that it's also bullish, right? So if we want to see any respect of this zone on your daily time frame or even a weekly, right? This is a weekly resistance area. We need to first see that change in structure happen, right? With lower lows and lower highs. And this itself, right? If it corresponds to an RSI exit of that region, you can see that if price exits the region, right, with a divergence, then this would be best, right? So let's take a look at another example, right? So let's say here, you can see this area. So let me just go back slightly, right? Let's see this zone, right? If it corresponds to anything on the weekly. Okay, so you can see this area right over here. If I were to just move back, so nothing much on the weekly time frame, I would say. Right, you have a support region over here. You can see this area, right? So if I were to put it in close, you can see this was the previous support area. Why? Price came in. You see the hesitation, and the hesitation broke above it, came back into this zone, right? So when price came back into this area here, this is the support area, right? This is the first sign that we're first signal that prices are sitting on the support zone. Okay, so I'll just remove the rest of the drawings. I'll keep this gray zone, right? But we'll keep remove the rest of the drawings. So in this case, right, let's see. So price comes into the support area that we have over here, right? You can see that for RSI itself, right, there isn't much that you can see. We do see RSI for the daily. You can see that RSI exited this oversold region, right? And this is corresponds to this move up. So that's one, right? So RSI exiting the region, but we don't want to trade it solely in isolation, right? We want to ensure that if there is indeed a respect of this, there is first a change in structure on your lower time frame, right? So when that happens, you can see that this is on daily. If I go back to the 4 hours time frame, so on the 4 hours time frame, right, what we have here. So right now prices are sitting on this support area, right? We have that change in structure here, and the first sign of a change in structure actually comes in over here, right? So price came in, it forms new lower lows and low highs. and then it broke above this high. You can see the first change in structure comes in here, right? It might be a bit late. You won't be catching the bottom because the bottom is this area here. And this bottom, if you take a look closer, you can see that there's a bullish divergence. Price continues forming lower lows, but on RSI, it's actually forming higher lows, right? This area here. So this is the first sign of a potential reversal, right? But if there are no other further confirmation, unless you go down to the lower time frame, right? If you're just trading solely based on higher time frames, let's say maybe the monthly, weekly, daily, 4 hours, right? For example, then this case, right, you need to wait for the change in structure, which comes in over here, right? So when price broke above the high, that's the first sign of a change in structure. So the first break, which is here. And then when it pulls back, we know that if it's in a bullish structure, it shouldn't be breaking past this, right? So when price pulls back into a support area here, you can see on RSI, right, when it's in a bullish structure, RSI hardly comes near the oversold region, if you notice, right? You can see on the lower time frame, right, if prices are bullish, right, it starts forming high low, high highs and continue to the upside. You can see that there's excuse me, there's a very rare chance for price to come into the oversold region, right, and exit the area. You can see that this areas here, right, usually it's just a crossover of the RSI from the midline. So midline is the 50 line, right? So these are the extremes. So if price exits, then you can see that it's usually accompanied with a reversal. If price exit the oversold, it's accompanied with a reversal to the upside. So we need to ensure that when prices are showing a clear structure, right, you might want to tailor RSI accordingly, because if in this case, right, you can see that RSI itself wouldn't have given much signals, right? You have missed this area here, and this is a valid signal because of that break in structure. So this is one. Right, when price comes into a support area, you want to consider putting or getting out of the trade if price breaks below this area. And then once again, that break in structure here, you can see price broke above the high, pulled back, came into the support area again. And once again, right, this is accompanied with that structure change. Okay, so yep, so I hope that this is clear, right, in terms of how we can use RSI for our trading. Right, so in summary, right, this is what we've covered. We've covered on bullish divergence, right, bearish divergence, and more importantly, how we can not trade them in isolation, right? The importance of trying to combine them with market structures. And we saw the example, right, where on bullish divergence, prices are forming higher lows and forming lower lows and lower highs, right? And then the divergence combined with market structure, it gives us a higher entry setup. But if you're trading solely just based on divergence, right, in an uptrend, any divergence is just represented by a slight pullback in price before it continues to the upside, which would get us trapped. Okay, and then we'll talk about how we can combine market structures and divergence, right, and how we can manage the risk in our trading, as well as looking at other technical indicators, right? So for next session, we'll cover more on divergence and how we can combine with other technical indicators, right? So this can be trend following indicators like your moving averages, for example. Right, so after you have a confirmation from the divergence, right, if you want to accompany this with a crossover above the moving average for buys, right, then to give more accurate signals, that's okay as well, right? But just understand that for moving average itself is a lagging indicator, right? So it might not have signaled the reversal at the start, right? So this, you will be catching the trend at the later part, right? Once prices develop, consolidated, and then, we are seeing that move up. Okay, so I hope that this is clear so far, right? If you have any questions, right, do feel free to type it in the chat. Okay, so if we have no questions, right, that's all that we have for today, right? So for tomorrow, we will be doing a live analysis session and a review of the setups, right? If you do want to sign up for the Vantage webinars, just go to vantagemarkets.com/webinars. If you have any questions, right, do email us at support@vantagemarkets.com. Okay, so with that, we've come to the end of the session, right? Thanks everyone. Stay safe, take care, and we'll catch you guys again tomorrow.